I mean, the whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower.
Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing the worst settlement.
In this video, Andy explains inflation in the U.S. is significantly higher than official figures suggest, with independent estimates indicating real inflation could be over 10%. This undermines the real returns on bonds and equities, meaning that even investments showing positive nominal gains may actually be losing purchasing power. Traditional measures of inflation are misleading, and the Federal Reserve has struggled to meet its 2% target for over 4 years, highlighting the challenges in maintaining economic stability. Traditional investment strategies, such as the long-standing 60-40 stock-to-bond portfolio, are no longer effective. Bonds are vulnerable due to low yields and inflation pressure, while equities are exposed to record speculation, leverage, and margin debt. As a result, institutional advisors increasingly recommend allocating a significant portion of portfolios to gold as a hedge against inflation and currency depreciation, usually at the expense of bond holdings rather than stock positions. The dollar has lost substantial purchasing power when measured against gold and silver, revealing that comparisons to other weak currencies often mask the true decline. With the Federal Reserve constrained in its ability to manage rates without disrupting markets, the old investment frameworks based on dollar stability and bond performance are no longer reliable. Investors now need to reassess their portfolios, hedge against inflation, and adapt to a fundamentally altered macroeconomic environment. The current financial environment requires a shift in perspective. With inflation eroding real returns, traditional portfolios under pressure, and the dollar losing purchasing power, investors can no longer rely on old strategies. Allocating to gold and carefully reassessing bonds and equities is becoming essential to preserve wealth and hedge against uncertainty. Staying informed and adapting to these structural changes is key to navigating today's markets successfully. If you found this analysis helpful, don't forget to subscribe for more insights and updates on investing, inflation, and wealth preservation strategies.
You're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central banks started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this, and at the same time, but that excluded the New York traders all this time until November of this year, and now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month, and again call it reverse psychology, use it contrarianism. That's a word. Why isn't anyone talking about this on the mainstream? Why do you not hear about the record deliveries? Who's taking billions upon billions upon billions? I mean, keep on going, billions upon billions every single month. Who's doing it? Who's bleeding dry the LBMA? Why is there no talk of this? It is because the lack of journalistic integrity or effort on their behalf to tell anyone what's truly happening, including the people who are trying to decide which way to invest, is ridiculous. And it's just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going in the access market when New York was closed, when there were no markets open before Asia opened, when no trader, Alasdair will tell you, that trader would be fired and shot, and not in that order. Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing the worst settlement. And then, of course, who did I mention? Bank of America and Morgan Stanley? Well, Michael Lynch says they came right in and scooped up physical, shows the numbers, and silver went right up. So this is all a game that is being done for maximizing the effect, the fear. And there is not one rational trader on the planet that would do that, would dump it in the access market. They would dump it over hours or days, slowly bleeding it into the system, not telling these traders how much they want to sell, slowly, so that the demand would be commensurate with the supply. But they failed to tell you that. They should have said all of these things are true, but they dumped it. They dumped it when there was no market open. So everything they say is invalidated. And all the sell stops that triggered, freaking everyone out, getting all what's going on with gold, what's going on with silver. They never called when gold was going up for 9 straight weeks in a row. And I think the powers that be understood we were entering a period of time where the public was waking up. That's a bad thing when you have a wicked short position. It was damage control. It was short covering. It was fugazi. And you'll see it right back up, I promise you, before the music stops. If this had been done the right way, slowly bled out over days and weeks in New York trading, I'd be less confident. But any idiot, stupid idiot that would dump it like that when there's no traders, well, that invalidates everything that the media said, no matter how rational and logical and valid those statements may be otherwise. That's just my 2 cents.
Well, I actually want to just pick up on an earlier point you were making, Andy. The largest mine in the world is COMEX, because this year so far it's delivered around about 1,200 tons. That's three times China's total gold mining effort, annual effort.
There you go. And who is it? And why don't we hear who it is?
Well, that's for us to guess, isn't it?
Legendary analyst Alasdair Macleod warns that the global financial system is sitting on the edge of a massive credit bubble, one built over years of easy money, aggressive lending, and artificially low interest rates. According to Macleod, the dramatic rise in asset prices, especially equities, has little to do with real economic strength and everything to do with unprecedented liquidity injected by central banks and commercial credit expansion. The surge in the S&P 500, he argues, isn't a sign of a booming economy. It's the byproduct of a debt-fueled system. And when that credit expansion begins to unwind, the correction won't be gentle. Liquidity that pushed markets higher will evaporate just as quickly, pulling asset values down across the board. When the bubble pops, Macleod warns, investors will sell whatever they can, not what they want to, in order to raise cash and stay solvent. Even traditionally defensive assets like gold mining stocks may be dragged down in the initial panic as selling becomes indiscriminate. Yet this sell-off phase, he emphasizes, will not last forever. The real turning point comes when confidence in the credit system cracks. At that moment, physical gold and silver, held outside the banking system, will become extraordinarily scarce. With most investors still holding paper claims rather than real metal, prices will be forced dramatically higher to reflect true supply and demand instead of leveraged derivatives and speculative trading. We are nearing the end of the fiat currency era, Macleod cautions. The transition to whatever comes next will be volatile, marked by sharp market swings and currency upheaval. His prescription for surviving what's ahead is clear and simple. Own tangible assets, not promises. Real gold. Real silver. Now back to the interview.
When Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different. Everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on two things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners will be selling what to them are foreign stocks, and bear in mind they've got 16 trillion invested in US stocks. The whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, this is plainly ridiculous. It should be 30 or lower. So the two monetary metals, I think you take a position in those, and then you've got to play the end of the bubble.
Something deeper.
something much deeper is unfolding in the gold market than day-to-day price fluctuations. Beneath the noise, a powerful shift is underway, a steady migration away from paper financial assets and toward physical precious metals. While mainstream headlines obsess over temporary pullbacks, the true narrative is the relentless withdrawal of real metal from exchange vaults. Each ounce removed weakens the illusion that supply is plentiful and that paper contracts represent genuine gold. Behind closed doors, major institutions, sovereign entities, and private wealth networks are preparing for a monetary environment where leverage and financial engineering hold far less power. The recent sell-offs, sharp, sudden, and perfectly timed, don't resemble fear-driven liquidation. They look like transfer events. The hands letting go are not the strong ones. The hands accumulating are. This shift isn't happening in isolation. It mirrors the exhaustion of a credit cycle that has pumped cheap money into everything: stocks, bonds, real estate, and risk assets across the board. As liquidity tightens, confidence erodes. And that's when tangible stores of value reveal their true purpose. Gold and silver are not merely hedges against inflation or volatility. They are escape valves from a financial world built on debt and promises. We are witnessing a global reconsideration of trust, a movement from digital claims toward verifiable, physical wealth. As this transition accelerates, the real question is whether the broader public will notice before paper claims detach from reality and vault shelves are left bare. If you're here for grounded, data-driven insights into the evolving financial system, make sure to like, subscribe, and stay plugged in. This shift is happening. The key is recognizing it before everyone else does. Thank you for being here, and enjoy the journey.
We are in a credit bubble. There is no doubt that bank credit has been expanded in favor of financial assets. And more than anything else, this is really what drives equity markets in particular. And we've seen this. We've seen this really over the last 2 years with the S&P rising from 4,000 or less or whatever. Currently, we're looking at 6,900, thereabouts. I never follow it that closely, but we're talking about a substantial rise.
The Macleod explains that we are currently in a credit-fueled equity bubble, with bank lending and margin debt driving markets higher. Over the last 2 years, the S&P has surged from around 4,000 to near 6,900, supported by modestly drifting bond yields. Margin debt has skyrocketed from $250 billion a decade ago to $1.12 trillion today, amplifying risk and creating substantial froth in markets, reminiscent of the roaring 1920s where wealth was concentrated in major cities while the general population saw little benefit. They warn that bubbles inevitably burst, and when this one does, the collapse could be sudden and severe. Investors left exposed to over-leveraged positions could face massive losses, while rising bond yields and margin calls will add pressure. Zombie companies reliant on cheap credit may fail, and governments with large debts will struggle with higher financing costs and falling tax revenues, worsening budget deficits. For investment strategy, the speaker advises gradually reducing exposure to momentum-driven assets and waiting for the market correction to rotate into commodities and mining stocks, including gold, silver, base metals, and agricultural products, which are likely to benefit after the bubble pops. They stress that central banks cannot fully control yields, as credit risk will dominate the market, and investors must consider interest, borrower, and purchasing power risks when planning. Stay informed, stay prepared, and don't forget to like, subscribe, and share your thoughts on this major shift in the comments below.
The background to this has been a gentle drift in bond yields. They peaked, if you look at the 10-year, it peaked at around just a bit under 5%, I think, a couple of years ago. It's gone back and up and down. And currently it's around about 4%. So that has been a fairly benign background against which there has been a substantial increase in the amount of credit aimed at assets. And if you look at the level of margin finance, which is a statistic that FINRA runs, margin finance is running at an all-time high. we're looking at $1.12 trillion. Bearing in mind that 10 years ago, we were looking at about $250, $300 billion. We're now, we're now well over $1 trillion. Now, the point is that finances positions probably about 3 times that. So there is a substantial amount of froth in these markets. So we have an equity bubble. So far, this is rather like the Roaring '20s, 1926 to 29, when everything was tickety-boo. Everybody in Wall Street was extremely happy. People in Main Street weren't doing terribly well. They were holding body and soul together, but not an awful lot more. But, the real happiness was really in major city conurbations, where all the wealth was being created in markets, and it was sort of spreading out into the restaurants, into second homes, into fancy holidays and all the rest of it. And that's where we are today. The problem with these bubbles is that they do come to an end. And when they come to an end, it can be really quite sudden and quite violent. And I think for an investment manager, that's the first thing he's really got to understand. He may be a very clever fund manager and made an awful lot of money for his clients by, sort of playing the momentum stocks and Bitcoin or whatever. But just bear in mind, the whole thing is driven by credit expansion, aimed at puffing up assets. And that basically is what's been happening. That comes to an end. And if you're left holding the baby when it ends, you are going to lose an awful lot of money. So I think that's the first thing that you've got to plan for. When it pops, then there is going to be a huge second problem, because when it pops, you're going to get a market that goes down considerably. I'm talking about equities here. You will see an increased amount of risk in bond markets, which basically means their yields will rise at the same time. Now, this is an awful combination, but this is what happens. This is what happens when a bubble pops. And consequently, you find that, all that margin debt, it gets foreclosed, and you get a situation where people who have portfolios which they're using to secure other finance, they get sold out because it no longer covers the bank's liabilities. You've got other problems that come from the increased risk being reflected in higher bond yields. You've got all the zombie companies in the economy who took out all that debt, particularly when interest rates were at the zero bound, and in other countries at negative interest rates. They're in the business now of having to refinance that. We're looking 5 years on. So this is not good. And as far as government is concerned, they've got huge debts, which are going to prove to be even more difficult to finance in the event of rising bond yields. So how do they handle all this? They're going to have suddenly all these obligations coming through, because apart from anything else, their welfare obligations are going to go up. And at the same time, their tax income is going to go down. So they're going to have larger budget deficits. So, this is going to be very, very difficult. So that's the second, if you like, element, which I think you've really got to start thinking through. In terms of investment strategy, I would look to sort of start easing my way out of the momentum stocks. They may go further. You're never going to hit the exact top. But I would look to lessen my exposure to those. And the other thing I would then do, and maybe not immediately, because I think as the bubble pops, you're going to get a substantial amount of selling across the board. And anything where people have got profits, they're going to be just realizing them and running the losses. That's the way it works. So there is going to come a time, I think, when you're going to sort of start thinking, right, we've got to invest in mining stocks. And I'm not just talking about gold and silver, but base metals in particular, agricultural products perhaps, because I think these prices are going to rise. They're going to rise very, very substantially. That's going to be the new place to go. And good technical analysts are already seeing this beginning to develop in the wider commodity sphere. So I think that's your game plan. The timing obviously is up to the individual investment manager, and I wish him jolly good luck. So to summarize, I think the first thing is you've got ahead of us, we've got a credit bubble popping. But realize that when it happens, this sort of neo-Keynesian idea that the Fed can control interest rates and bring down interest rates and bring down bond yields. No, that's rubbish. That's not going to happen, because what will happen is that bond yields will start reflecting the risk in credit. Not risk, but just add the three elements of this risk. If you go and buy a bond, you're losing possession of the money, if you like. It's going into the bond, so you can't use it for something else. So there's an element of interest payment to cover that. You've also got individual borrower risk. So that is another thing that you take into account. And increasingly now, there is another factor. And that is, when I get my money back, let's say dollars, let's say in a year's time, what's it going to buy? What's it going to be worth? What's the purchasing power of that money which I've committed to a bond or whatever? What's that going to be worth? So you can see that these three elements are likely to rise quite considerably as credit risk begins to dominate our thinking. And under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say in the current situation.
Yeah, I think it's important to highlight those in the respect that a lot of what Alasdair is talking about, it deals with just this: monetary inflation, asset valuation, the inflation-adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55 straight months or thereabouts of 2%, in fact, missed it by 50%, they call that tepid. I don't know how missing your rate by 50% is tepid. It seems kind of way off base to me, but there's a lie, of course, about what inflation really is. It should be called the CP lie and the BS, not the BLS. And we know that. We've talked at length. John Williams says inflation's 11%, shadowstats.com, not 3.
In this video, Andy explains inflation in the U.S. is significantly higher than official figures suggest, with independent estimates indicating real inflation could be over 10%. This undermines the real returns on bonds and equities, meaning that even investments showing positive nominal gains may actually be losing purchasing power. Traditional measures of inflation are misleading, and the Federal Reserve has struggled to meet its 2% target for over 4 years, highlighting the challenges in maintaining economic stability. Traditional investment strategies, such as the long-standing 60-40 stock-to-bond portfolio, are no longer effective. Bonds are vulnerable due to low yields and inflation pressure, while equities are exposed to record speculation, leverage, and margin debt. As a result, institutional advisors increasingly recommend allocating a significant portion of portfolios to gold as a hedge against inflation and currency depreciation, usually at the expense of bond holdings rather than stock positions. The dollar has lost substantial purchasing power when measured against gold and silver, revealing that comparisons to other weak currencies often mask the true decline. With the Federal Reserve constrained in its ability to manage rates without disrupting markets, the old investment frameworks based on dollar stability and bond performance are no longer reliable. Investors now need to reassess their portfolios, hedge against inflation, and adapt to a fundamentally altered macroeconomic environment. You said, with inflation eroding real returns, traditional portfolios under pressure, and the dollar losing purchasing power, investors can no longer rely on old strategies. Allocating to gold and carefully reassessing bonds and equities is becoming essential to preserve wealth and hedge against uncertainty. Staying informed and adapting to these structural changes is key to navigating today's market successfully. If you found this analysis helpful, don't forget to subscribe for more insights and updates on investing, inflation, and wealth preservation strategies.
So nominal returns, to Alasdair's point, are an illusion when inflation certainly is higher than we think. But, even at 3%, and they're trying to push rates down below that, but even say you get a 5% return, right now you're losing in real terms by John Williams' measurement, a negative 6% real return. And in that environment, where you, to Alasdair's point, have record participation by the public in the equity market, record amount not only of margin debt over $1 trillion, but also record speculation and leverage with options. Bonds are very vulnerable, and equity valuations are very distorted. So earnings may rise, but real purchasing power is falling. But the real trouble, to Alasdair's points, in the bond market, and that's why when you see the chief investment officer of Morgan Stanley come out and say, well, the 60-40 rule that we've used, 60 stock, 40 bonds for 50 years. Now remember, and since 1982, when the interest rates have fallen straight down at a 45-degree angle, if you're 60 stock, 40 bonds, you'll retire wealthy, period. That's not really the case anymore. And so as the chief investment officer of a large commercial bank who has never acquiesced to anything more than a pittance of gold in your portfolio, he says, sell half your bonds and buy 20% gold, 60-20-20. You got Michael Hartnett, the chief analyst at Bank of America, says, no, shouldn't be that either. It should be 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You have Jeffrey Gundlach, the bond king. I think he's the head of bonds for BlackRock, says, 25% allocation to gold is not overweight. This is a guy that's made his living selling bonds, the antithesis of gold. And you have all of these institutional level advisors and chief investment officers saying, yeah, you need to own some gold right now. And in all three cases, it's at the expense of the bond portfolio. You didn't hear them say trim your 60% stock portfolio. So yeah, right now I think there is no question that the world is beginning to understand that not only is the Fed trapped, raising rates blows things up like the bond market and all of the institutions that hold their wealth in treasuries like the banks and the insurance companies and the real estate market. And we're already looking at a Fed, they're projected here to lower rates into an environment where they're missing their target by 50%. That's acquiescence. We're going to give up, in essence, our mandate without really acknowledging it to inflation target of 2%. And by the way, it's funny, as a side note, just for those people who haven't heard, I asked Judy Shelton, I said, Judy, why the hell did they ever come up with this stupid 2% rate anyway? Shouldn't it just be zero, flat prices? Wouldn't that make standard of living better? She says, it was Janet Yellen's husband who came up with it, actually, and he said, if you do that, you can't give your employees raises because it'll come from the bottom line if everything is stable. But if you have a 2% inflation target and give your employees a 1% raise, they feel like they're getting ahead even though they're falling behind. And that's really what's happening here. We're all falling behind in the face of a dollar that is losing value precipitously. Last thing I will say is that when we look at the value of the dollar in terms of purchasing power, which is important because that's really what it is. Alasdair says you might get your money back, but what's it going to be worth? We're misled by measuring it against the Dixie, the other crap currencies that are all losing value. And the dollar was down 11% against these crap currencies. It's rallied back to 7 or 8%. Okay, but let's measure it against gold. It's down 50%. Against silver, 60. How about last year? Same thing. When you measure, if you go back to 1971, James Rickards would say gold should be $94,000 right now, measured against gold. When you measure the dollar against a basket of worthless currencies, it's masked. So everything that we are doing is stacked against us in measuring against a basket of worthless currencies. Measured against gold, and everything is falling in price. And I think the asset managers must understand that even the best laid plans, those that have worked for 50 years wonderfully in an environment of dollar supremacy, in trust of the institutions of this country and of the bond market that has been weaponized and sanctioned, those things aren't the same anymore when that environment changes. So yeah, to Alasdair's point, you must pivot if you are looking at a macro perspective here. And when you see all of this congregation in the equity market on leverage and on margin and using options at record levels as the institutional sized traders and have been selling all year, and Buffett sitting on $500 billion in cash, what could possibly go wrong? The best laid plans need to be reevaluated, and this is the time to do so.
If you look at the level of debt in the United States, I mean, the US government's debt, is about 115% of GDP. The ability to pay that comes out of the private sector, the taxes, if you like, that the financial and non-financial sector provide to the government. That's the important thing. Now, if the economy goes into recession, then that impairs the ability to cover those, to cover the interest cost, and indeed to service the debt. And that basically is what we're seeing. I mean, I put out a piece this morning, and one of the charts in there was the interest on debt. And I tell you, it's scary. It's just, I mean, it sort of goes along like that, and then, it's done that. That, if you like, is really what's happening with the debt trap. And that's why this can't be muddled through anymore. This is coming to an end. I mean, it's actually as simple as that. You need to look at the whole thing in the round. The idea that we can continue to run high levels of debt. I mean, the other thing is that, we did have higher levels of debt. Most countries had debt to GDP of 160, 180, 200% at the end of the Second World War.